This analysis report we have here, it lays out the emerging bull case for UiPath, focusing on that big strategic pivot from old school RPA to what they're calling agentic AI.
Right.
It's a compelling story for sure. It positions them as the essential plumbing for automation in the enterprise. But to really maximize its impact, I think we see three key areas where the defense needs to be shored up and right away.
I'm with you 100%. The piece does a great job synthesizing the why now, why analysts are getting on board before 2026. It touches on profitability, the valuation discount, all of it. But if the goal is to drive real conviction, especially with sophisticated investors, you have to anticipate their biggest concerns and, dismantle them inside the argument itself.
Let's start right there then. The analysis could significantly boost its credibility by more explicitly weaving the rebuttal to that persistent bear view throughout the main arguments, rather than, just isolating it.
Exactly. The bear view that AI makes RPA obsolete and growth is just going to stall out at 10%, it's listed almost as an afterthought near the end.
Yeah, it's just kind of stuck on the back page.
And that placement, it just minimizes the threat. It makes the whole bull case feel a little untested against its primary challenge. I mean, if that bear case is what's keeping the stock at a 4 or 5 times sales multiple, it needs a head-on fight chapter by chapter.
It's amazing how much that old rigid bot narrative still has a grip on the market. We really have to frame this agentic AI pivot as the direct answer to that legacy fear.
Right.
The weakness here is structural. By separating the bull and bear cases, you're forcing the reader to do all the defensive work themselves.
That's the key. So, to build a truly robust report, the suggestion is to integrate those preemptive counterarguments directly into the core sections.
Especially when you're talking about the agentic AI engine and the Microsoft partnership.
So you move it from just a list of positives to a really persuasive defended thesis.
You shouldn't wait until the conclusion to address obsolescence. You should be squashing it from the very beginning.
Okay, that's laid out pretty clearly. But how do we execute that? How do you do that integration without constantly pulling focus from the main growth story? It's all in the language. You use targeted phrasing that hits the old pain points. So when you're discussing the agentic AI engine, Maestro, in Section 1, use language that explicitly counters that obsolescence argument.
So you detail how its adaptive nature makes that old bot breaks if a button moves problem totally irrelevant.
You got it. You're not just saying agentic AI is better. You are showing precisely why it is the antidote to the biggest complaint about legacy RPA.
So every time a new agentic feature is introduced, you follow it up with, and this is what fundamentally fixes that fragility the bears always harp on.
Precisely. And then you apply that exact same proactive defense to the partnership piece. When you argue the strength of the Microsoft deal, don't just say the integration is bidirectional. You have to emphasize the structural barrier to entry from Microsoft to replicate UiPath's critical infrastructure access, what some analysts are calling the hands.
The hands. Right, those deep, messy integrations into legacy systems like SAP and old mainframes. That's a powerful moat that, you're right, probably needs more weight.
Absolutely. Because if you can prove why this synergy is necessary infrastructure for Microsoft and not just some temporary coexistence they'll eventually absorb, you immediately neutralize that huge Microsoft will kill UiPath fear.
Right.
You have to spell out that the decade plus of custom integration work UiPath has done can't just be replicated overnight, not even by a giant like Microsoft. By reframing it that way, you turn the biggest bear threat into a positive structural advantage.
Okay, so we've strengthened the strategic defense. Now, if we shift from the narrative to the financial engine underneath it all, the second opportunity is really about connecting the capital structure to the valuation goal.
Right.
The report needs a much clearer quantified link between UiPath's impressive financial metrics and the path to actually hitting that aggressive $18 to $20 price target from the DCF models.
The financial profile is, it's undeniable. A fortress balance sheet, $1.5 billion in cash, negligible debt, and just, cranking out free cash flow.
It's a major strength.
It is. But the way the analysis is structured right now, that cash is just listed as a passive strength, and then later you see the $18 DCF target, and the two aren't really married. They don't feel connected.
As I see it, the market skepticism, that 4 to 5 times sales multiple, it isn't just about growth. It's skepticism that management will actually deploy that massive cash pile to drive shareholder value. The argument, as it stands, it suggests acquisitions or buybacks, but it's not explicitly integrated into the valuation section as the mechanism that's going to cause a re-rating.
And that is the crucial gap to fill. The analysis has to move beyond just listing the financial strength. It needs to model how management's capital allocation strategy will directly catalyze that valuation re-rating.
Ah, okay.
That's what makes the $18 to $20 target feel earned, not just, projected based on a hope that multiples will expand someday. We have to answer the question, how does $1.5 billion in cash get you to a 10 or 15 times peer multiple?
So we need scenario analysis, something that quantifies the impact. What are the most powerful levers to pull here to demonstrate that?
Well, share repurchases are the most immediate and quantifiable one. You could include a scenario that models the instant earnings accretion from using a specific tranche of cash, let's say $500 million, for buybacks.
Okay.
You can immediately show the reader the new, higher EPS figure this action creates, and that forces a reevaluation of the current multiple, right there.
That's a very specific, actionable lever. It shifts the whole discussion from potential to probability. But is there a risk that focusing too much on financial engineering kind of distracts from the core agentic AI growth story?
That's a fair challenge. The key is balance. If the analysts believe M&A is the focus, which, higher risk but potentially higher reward, then they must specify the type of acquisition that would justify a sudden expansion of the total addressable market.
So you can't just say M&A.
No, you've got to name the vertical or the technical capability that UiPath should be acquiring. For instance, M&A focused on specialized vertical AI in healthcare that immediately adds X billion to the TAM. That cash has to be positioned as an offensive weapon aimed directly at shrinking that valuation discount.
Right. Right now, the cash is a powerful engine without a clear destination that's linked to that $20 target. Excellent point. Okay, let's pivot to the core thesis of this whole report, the agentic AI transition itself. To really validate the agentic AI growth engine, the report should better quantify the transition timeline and, crucially, address the potential cannibalization risk of the legacy RPA business.
This is the heart of it. The pivot from scripted bots to autonomous agents is the whole reason this bull case even exists. It's exciting.
Totally.
But if this shift is the reason for the forecasted 15 to 20% growth acceleration in 2026, the report has to detail the financial dynamics of that transition with a lot more clarity.
The material makes a strong case for more users through things like autopilot for everyone. But there's an implicit risk that this wide adoption might actually cannibalize the higher margin traditional RPA licenses, right? If the shift in contract value isn't super clear.
You're trading low volume, high value for high volume, potentially lower value.
Exactly.
And is there a risk that focusing just on high adoption overlooks the pressure on existing high-value contracts?
Absolutely. The analysis would benefit so much from projecting the expected revenue mix shift over the next fiscal year.
Okay.
This makes sure the argument for net new ARR growth, which is that critical Q3 catalyst they mention, is robust against that internal pressure. You have to prove to the reader that the new agents are fundamentally additive, not just substitutive.
I see. It's all about making sure the growth from agentic AI isn't just backfilling a decline in traditional RPA. So how do we provide that level of granularity in the analysis?
You need specific metrics. The analyst should include projections detailing what percentage of that expected growth acceleration in 2026 is modeled to come specifically from the new agentic AI products, Autopilot and Maestro, versus just renewals of the traditional stuff. That separates the signal from the noise, which is critical.
Yes. And to hit the cannibalization risk head-on, they should explore how UiPath's pricing structure for the new platform is designed. How does it ensure that more adoption by regular employees translates into higher overall enterprise spend?
Right.
That's how you take the risk off the table. The risk that these new, easy-to-use agents just replace a few of the old, expensive legacy contracts. You need to show that the new price model scales exponentially with usage. If it's tied to compute power or tasks executed, that is a really compelling rebuttal to the whole cannibalization argument.
This has been a very targeted critique, really focused on maximizing the conviction of this bull case for UiPath. So, to summarize, we've basically identified 3 core opportunities to make this analysis report stronger.
First, and this is maybe the most critical one for market perception, you have to integrate the bear case rebuttal directly into the core arguments. Don't isolate the threat. Confront it proactively and prove the thesis is resilient.
Second, when talking about that powerful balance sheet, model the strategic use of cash. Explicitly link that financial strength to the $18 to $20 DCF targets. Show how capital allocation is going to force a multiple re-rating, whether it's buybacks or targeted M&A.
And finally, to validate that core agentic AI thesis, they need to give more granular detail on the transition and proactively address the cannibalization risk. Quantify the revenue mix shift between the legacy products and the new AI products.
This is already a fundamentally strong analysis of why analysts are upgrading UiPath. By making these adjustments,